Jeremy Nelson, a partner at Element. Well, Jeremy, good to see you.
Always a pleasure.
I'm not sure if we talked since the election.
No, I think this is the first time.
I think so, too. Well, of course, very much relevant to your line of work and the economy is the Treasury Secretary. And I've been waiting for that one after all the other pieces started to come into place and the puzzle was being populated. But Treasury Secretary, there were a number of names that were kind of in that mix, and the president-elect decided on Scott Bessent. He's kind of like you. He's an investor. He manages folks' money, and he knows how to make money for sure. So what do you think?
Yeah, so, they say that he's got a pretty good handle on the bond market, which is, really, if you think about it, one of the biggest things that the Treasury Secretary has to do is the financing of the debt and the country. And so I think that having someone that has that kind of experience is good. I think it's good that we've got someone who is going to be focused on the job and not things that aren't within their purview. Yeah. So, we were talking a bit off air how, Janet Yellen, she was an interesting pick, and she seemed to be focused on a lot of stuff that had nothing to do with what the Treasury Secretary was supposed to be doing.
Right.
And so I think here's somebody who's coming in. He talks about a three-pronged approach. Right? He talks about driving GDP growth up to 3%. He talks about reducing the deficit to 3% of GDP, which is about half of what it is today. And then he talks about producing more oil to keep inflation down. So now, how you get there is a little bit of a challenge, right? We saw in Trump's first administration, we didn't quite get up to that consistent 3% growth. There was a little bit of an uptick from the Obama administration, but we did see some deficits uptick. So it's going to be interesting to see how the policy is formed to hit that 3% growth target, to reduce the deficit as a percentage of GDP down to 3%. But I do think that it is doable, and I think that he's put someone in place here who is going to be focused on that, and I think we'll do a good job.
So just to clarify for the folks, he's proposing what he calls the 3-3-3 plan. It so reminded me of the late Herman Cain when he ran for president. Remember his 999 plan, remember? Yeah. And this is a 3-3-3, and you just discussed the first component of that being to pursue 3% GDP growth. Mm-hmm. And that would be higher than anything we had in the first Trump administration.
Yes.
He had under 2, I think.
Under 2.
Yeah. And, of course, now we're under 2 as well in the Biden administration. So 3% GDP growth, reducing the deficit to be 3% of GDP.
Yes.
And then increasing the output of oil by 3 million barrels a day, which would be significant, honestly, because we're producing right now about 13. So last I checked, 13 million. We consume about 19.
It would be a big uptick. Now it'll take time to get there, and some of it's going to be kind of reversing some of the executive orders and the mandates from the Biden administration, so we can get the supply back up and going. But look, long term, I don't know if anyone started watching the Landman on Paramount Plus, but you start to learn about the oil industry a good bit there and the importance of it. I was watching that last night, but it's important that we have that infrastructure with regard and supply with oil, because the reality is, as much as we want to talk about diversifying and going electric and all that kind of stuff, we're not there. We're not even close.
Right.
It's stupid, because all you're doing is setting yourself up for an energy crisis down the road. So yes, would it be great in the future to have a more diverse energy infrastructure? Absolutely. But you got to realize where we are today, we don't have the transmission for the electricity.
Right.
Right? Wind and solar, it just doesn't produce what oil does.
Yeah. And I think we have Energy Secretary, Interior with Doug Burgum. Those guys, EPA, they all have to work together. I think they're more friendly to fossil fuels. Certainly, I don't think Trump would have selected them.
No.
Were they not?
No, definitely not.
He made that a marquee, did he not? A marquee promise on the campaign trail. We're going to drill, baby, drill. I mean, you heard it over and over again,
Yep.
and that was the central theme in his plan to grow the economy. So we have a Treasury Secretary now. Now, just how different is that? Just looking through, Treasury Secretary Janet Yellen right off the bat. I don't know if you know this or not. She sent out a statement to the department's workers that commitment to values of diversity, equity, inclusion is expected of every employee. I mean, so that's no place in the Department of Treasury, is it?
No, and look, by saying what I'm saying, I'm not saying that, we shouldn't have diversity. We should. And, equity in the sense of the best people for the jobs, right?
Right.
But this mandate to put less qualified people in positions, especially high-level positions within the government that are very important, right? I mean, you would never do this with your business, right? If at Element Wealth or when you ran your business, if you were like, well, I'm just going to hire people who aren't as good, well, that's a problem. Now, having people that are equally qualified or more qualified and have diverse opinions, that's great, right? Because that creates a better business. But just giving jobs to people because of their gender or race or whatever orientation they want to talk about is silly. And that's not the place of the Treasury Secretary, right? The place of the Treasury Secretary is to make sure that the Treasury markets are flowing, that the government is funded, all of those sorts of things, not worrying about these things that have nothing to do with what the Treasury Secretary is supposed to be worried about. And
also, the Treasury Secretary is to serve as a consultant to the president on fiscal policy as well. Now, the Fed, generally speaking, they don't dip their toe in that. And anytime, Jerome Powell gets asked about that, what do you think about all the radical spending and the $2 trillion deficits? He always says, no, we don't weigh in on fiscal policy.
Yeah. Now
but the treasurer does.
Now, they have strong opinions, because I remember a few years ago I was on a call with Ben Bernanke, the chairman during the financial crisis, and he said fiscal policy monetary policy can only bail out bad fiscal policy for so long.
Right.
And so, but the Fed really tries to be apolitical, right? They don't want to be a political lightning rod. They want to kind of do their job, stay out of the limelight as much as possible, which is difficult to do. But you're right, the Treasury Secretary works daily with the president. Right.
Supposed to advise the president on fiscal policy because they're the ones who keep the books, essentially. So.
And you and I have talked about this before. I've talked about with a lot of clients or people who ask me questions about this deficit because people are worried about it, and rightfully so. They should be. I mean, this is a major problem.
Yep.
We've got to the point where it's going to be hard to kick the can down the road much longer.
Yeah.
And I've always said that, look, there's three things that have to happen. One is you need to cut spending because there's a lot of fat that can be cut. Number two is you need to raise some revenue. Number three is you got to grow. Well, if you grow, that's going to raise the revenue. Right. And so if you have a focus on the deficit, you say, hey, look, we're going to be pro-growth. We're going to cut regulation. We're going to make it easier on business. That's going to help with inflation. But it's also going to create more growth in the economy, which grows revenue, which means you don't really have to raise taxes as much. And if you cut some spending, all of a sudden this budget deficit starts to look a lot better.
Yeah. Well, you've got, I think, in Elon Musk and Vivek Ramaswamy and now in Bessent, Treasury Secretary, people that believe we got to do something about this deficit. And honestly, you haven't even heard anything about that. Think about it. The last 4 years, all we got was Joe Biden bragging about how much he cut it from the previous administration, which was all just mathematical gymnastics to get.
It's a total joke because here's my point. I would say, okay, yeah, I mean, you stepped in after COVID. So, of course, I mean, if you couldn't cut that deficit, like you don't belong to be on Earth. At the end of the day, look at what the deficit is today. Look at what it was pre-COVID, and it's double.
Yeah, exactly. Yeah,
that's a problem.
We went from pre-COVID, we were about $900 billion. Last year, this past fiscal year just ended, end of September, $1.8 trillion. No end in sight at this point.
Not even close.
Yep. We'll come back, talk some more with Jeremy Nelson, partner at Element Wealth. Stay with us. The markets, Jeremy, we got Jeremy Nelson, partner at Element Wealth. They seem to be responding positively to this naming of Scott Bessent to be the Secretary of Treasury. They like it because, well, first of all, he's a pro-business guy, right? He has experience investing money, doing pretty well at it, making money. He's already announced his 3-3-3 plan. He's pro-fossil fuels. He's pro-economic growth. Janet Yellen never talked about economic growth.
No, she didn't. And again, that's the job of the Treasury Secretary, right? Is to consult on fiscal policy and make sure that the lubrication of the financial system in conjunction with the Fed is working,
which includes tax policy.
Yep.
Yeah.
And so I just fundamentally think that it's great to have somebody who's laying out a well-founded plan, right, that actually makes sense, that addresses growth, that addresses the deficit. He recognizes the issue. He recognizes the inflation and that we need more oil production in order to bring that down. So, yeah, I mean, kudos to President Trump on this one.
I think it's a good selection. So what folks want to know is, especially people that are looking at buying a house, what's your outlook? What's your crystal ball say about interest rates, for example?
So we're already seeing a little bit of softening in mortgage rates right now. Not enough. You're going to need – so two things have to happen. One is the 10-year Treasury needs to come down some. It's not going to go down so much that you're going back to 3% mortgages for 30 years. So just let's kind of get that off the table. That would
require a 1% Fed funds rate.
So what you're likely to see is that I do believe that you're going to see softening in longer-term rates, especially if you've got a government that is focused on bringing the inflation down. So I think you could see the 10-year Treasury ultimately settling down in that 3.5% range, maybe 1% lower than it is today.
Well, that would get us to a 5% mortgage rate.
So then then you have to get the spread down. What really happened was the spread between the Treasury and the 30-year mortgage really ballooned, and that's what's coming in right now.
Yeah.
And so as that continues to come, I think that we will get to a point where we'll have a 5 handle, like 5 point something, within the next couple of years. And look, any of our listeners who bought a house in the 80s fully understand, if you can get a 5.5% mortgage, that's not a bad deal.
I bought one in 81.
Yeah.
Yeah, I think I told you I stood in line all night down in Louisiana, the state of Louisiana, flush with cash at the time, trying to stimulate the housing industry. They went and sold bonds. Mm-hmm. And those bonds essentially used to capitalize mortgages, and they allocated a certain amount of those out to all the mortgage lenders in the state. And I stood in line all night. Yeah. State National Life Insurance, I remember it, headquartered in downtown Baton Rouge, was in the mortgage business as well. And that was to get 10 3/4.
Yeah. Yeah. Look, I remember my first one. I think this was back in 2004, and it was 6.75% or something like that. And
yeah.
It was what it was. People have just become so accustomed to these ultra low rates. I do not see us going back there. But, if you're sitting on one of these mortgages, anytime, generally speaking, you can cut 0.5% or for sure 1% off the rate, it makes sense to refinance.
But I think the problem is, it's a little different than when I bought my first house at 10 3/4 interest, which, by the way, there was 17% was the prevailing interest rate at the time. You had to be a first-time home buyer and make less than $30,000 a year. My wife and I easily met that standard. I think we made about half of that. But what I'm saying is we've experienced a dramatic increase in the price of housing. So that's a double whammy.
That's kind of the real challenge here, right, is that housing prices they shot up after COVID. And mortgage rates were super low, and there was just a huge demand. What's been interesting is that even as interest rates went up and affordability became less, the prices really held in there and have stayed elevated. They really stopped going up We're turning a little bit more into a buyer's market now. You don't have to overbid everything like you did a couple of years ago. But the prices have stayed up, and people aren't selling for a significantly reduced amount right now.
Yeah.
So
all right, let's talk about inflation. Where do you? The Fed's target's 2%. We're 2.6%. The last reading, they really like to pay attention to the CPE, the consumer expenditures. So, what do you think?
I think that we're on a trajectory where if they were rounding, they could round down to 2. I think that it's going to be hard to go below that. A couple things, right? One, if we're talking about tariffs are going to be somewhat inflationary, right? So that'll be part of it. We did see in President Trump's first term a bit of an increase in the deficit, in the trade deficit, even after he enacted some of those tariffs on China.
Yeah.
So I think that there's this last little bit of inflation that's going to be hard to get rid of. I think that the wealthy still have a lot of money and are continuing to spend. And I think that corporations have really held prices, right? That's why if you look at corporate earnings, they've held prices. They're making money, right? And so I think that the last little bit is going to be hard to cut. But things like increasing oil production, bringing the cost of oil down, remember, that goes into pretty much every product that you touch.
Yeah.
And so those will all be things that will help. Everyone thinks about gas prices, but we use so many more things that have oil in it.
Yeah. Yeah, it's embedded in almost everything we produce, and even the service economy, because there's a cost associated with being mobile, traveling, and so forth. I said CPE, I meant PCE. Of course, personal consumption expenditures. But I think folks are expecting we're going to return to the pricing of the 2019 period.
Which is not going to happen.
Right.
Right. Prices are not going down. That's deflationary. If you want to talk about a problem for the government,
big problem.
Have deflation, right? Because all of a sudden now you've got sales revenues, tax revenues for the state are going down. That's going to push incomes down, which is going to push down income tax revenues. So you don't necessarily want the prices to go down a bunch because that would be deflationary, which would be catastrophic with the deficits that we have right now.
Yeah.
Right? The government actually needs a little bit of inflation to start to inflate away some of this deficit.
Yeah, that's a good point. So generally speaking, that would mean recession, massive job loss, people got less money in their pocket to spend. All that would be deflationary, but it's also a very bad economy, a contracting economy.
The only thing that would push prices down would be a recession, which would be bad.
Yeah. But you could see some, there are some commodities, there's some food commodities that are volatile, of course, that could come down and go up and come down. And if the cost of inputs, such as oil and energy, come down, that could be a factor in that.
It definitely helps, right? But you've still got rising wages,
right?
And we've got a labor market that's softening a little bit, but it's still really strong.
And that's a major cost component, no matter what you're making, whether it's eggs or chickens or beef or other food products.
Look, I went to the grocery store yesterday to pick up my last-minute things, pre-last-minute things for Thanksgiving, right? And I walked out there, it's like, that cart wasn't very full, and that was $140.
I know, it's crazy. I really don't see how people do it. In fact, on the screen right now, price of eggs, November 24, $4.23. November 23, $2.43. So it's up substantially. But I got friends in that industry say bird flu and other things.
There were extraneous factors there that were causing that significant increase. I think we got up to $6 to $10 at one point. It was really crazy.
It's subject to just classic demand and supply.
There's always some things that are going to go up and some things that are going to go down. But think about a Coca-Cola. Think about going to the store and buying a 12-pack of Dr. Peppers or Coke or Pepsi's, whatever your choice is. Those prices don't come down. They really hold. Yes, there are things that are going to be more volatile, that are more subject to commodity prices. But in general, what you see is the core products that you're buying are not getting cheaper.
Markets. you optimistic?
So the trend is good right now. The party probably ends at some point. People are going to be surprised. But right now you've got a very strong market trend. You've got, obviously, a federal government that's coming in that's going to be much more, pro-market.
Pro-business, yeah.
But you're sitting here in the 97th percentile all-time in valuations. So it's going to be imperative that corporate America continue to deliver on earnings. Otherwise, people might be a little bit surprised what can happen.
And they'll get punished if they miss, right?
Oh, it's going to be, if they miss, it's going to be bad.
Punished. I mean, NVIDIA got punished just because they only went up, 74% year over year in the quarter instead of the expectation of 100, right? Something crazy like that.
Expectations are high, so I think investors need to stay diversified, be patient.
But there's still lots of opportunity.
Absolutely. I think there's room to run here.
And the U.S. equity market is the greatest wealth producer in history. Thanks, Jeremy.
All right. Thanks, Gerard.